Good evening, all the joinees. Thank you for joining in. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. In our topic for today, we will be typically discussing client portfolios. So meanwhile others join, let me simply introduce the topic for today and the subtopics that we would be really covering. So today we will be focusing our webinar related discussion on reviewing of client portfolios. When we review client portfolios, it becomes very, very important to not just compare its performance with the benchmark, but also check as to which of the components in the portfolio is contributing to the best to the portfolio return. When we do this, a tab that becomes very, very crucial in portfolio analytics on NGEN Markets is the contribution analysis tab. Now, in addition to contribution analysis tab, we will also have a look at overlap analysis, which helps us in understanding what is the actual underlying holdings overlap, meaning similar holdings of two funds. And then, then doing contribution analysis, we will understand how that really makes sense, wherein we can actually take decisions, okay, which is a better performing fund to be retained in the portfolio and which is the other fund which could be probably exited from, right? So this we will see in tandem, overlaps analysis as well as contribution analysis. Next, we will move on to understand the interpretation first of drawdowns analysis on a portfolio level, of course. What is the utility of that? And after that, we will have a look at what if analysis, kind of a scenario that you can check on NGEN Markets scenario analysis tab. Lastly, we will see how we can generate customizable reports, typically PPT reports, and add add maybe some comments and maybe some specific screenshots to those reports to make them more relatable for the client. Once that is done, we will throw the forum open for a Q&A session wherein you can get your questions answered by either typing in the chat box or directly unmuting yourself to speak. So let us now begin. So typically in the webinar related discussion, okay, I can see a message in the chat box saying that some users facing a audio issue. Is my voice clearly audible? Ansu, can you please confirm? Oh, okay, great. Okay, it is audible. Okay, so sir, can you please check your audio settings at your end? It is loud and clear for other participants. Okay, so let us now begin. Yeah, you can maybe exit and rejoin again. I think it should get solved. Yeah. Okay, so let us now begin. We will typically be going to the clients, and sorry, the portfolio section first, which will be where we will be loading a portfolio from. So let me do a full screen. We go to portfolio section and we will load in a portfolio for our analysis for the discussion today. So I've loaded in Rachel Green's portfolio. I click on run from this drop down and the entire portfolio analytics runs. So here the first thing that you can notice here is it's a 8 mutual fund portfolio. There are 8 mutual funds in the portfolio. Currently, each and every fund is a equally allocated fund. Okay, each of the 8 funds have an allocation of 12.50% in the portfolio. That totals to 100%. And that's how the portfolio is as of now, right? If you were to simply check where is the exposure coming from, right? So whether is it, or rather how much of it is coming from large cap, mid cap, small cap, and typically if there is any debt in the portfolio or not. The two tabs that would be very, very important for you to check is the overview tab and the concentration tab in asset allocation, which is the first section here. So the moment you come here, you will see a overview tab, which will give you a asset class wise split. So how much of it is coming from equity? Okay, and here you see, of course, here it's 100% exposure, 100%. But if you want to, let's say, focus only on the equity portion of it, which is 93.24% in the portfolio, you simply click on this bar graph, which is a blue color coded bar graph, right? You simply click on that and only 93.24% of the holdings, which is typically coming in from equity, will be showing here. Right now, for an example, if you want to further delve down to check, okay, my portfolio is as of now exposed to ICICI Bank as a stock to an extent of close to 6%. You want to check where is this exposure coming from. You have an option to simply click on this eye icon beside the name of the stock, and you see the underlying mutual funds, which happen to be a part of your portfolio, which hold some percentage of their own funds AUM into ICICI Bank. So all of these funds, Tata Flexi Cap, Mirai Asset Large and Mid Cap, GM Large Cap, and so on and so forth, these funds hold some percentage into ICICI Bank as a stock, right? And therefore, your portfolio is exposed to an extent of close to 6% to this particular stock, right? So this is available on asset class basis here. Now, let's say if you want to go a little, basically go on a second drill down and actually check how much of it is coming from large, mid, and small, then the tab that you should be focusing on is the next tab, which is the concentration analysis. We have given a pie chart wherein you can check as a percentage of your total portfolio, meaning out of 100% portfolio, how much is large cap, how much mid cap, how much is small cap, and then how much is others. So here in others, you will see everything that is not classifiable into large, mid, and small. So what all will not be classifiable? So the debt portion, the cash, and typically others, meaning the REITs that are really there in the portfolio, right? So which are coming from these particular funds. So this will typically form a part of others. And that is exactly what you can see in this 6.76%. So cash, debt, and some other REIT investments. Now, if you want to typically, instead of checking this as a percentage of whole portfolio, which is 100%, you want to check only the split between large, mid, and small of only the equity component of the portfolio. Because a simple reason, equity is only classifiable as large, mid, and small, right? So you have a drop down here wherein you can change this as a percentage of total portfolio to as a percentage of equity exposure only, right? The moment you do that, you will see that the others portion disappearing, and the entire pie chart will now be divisible only into large, mid, and small, right? So out of the total equity portion in the portfolio, that's close to 93%. If we standardize that to 100%, 75% is into large cap, 18% approx is into mid cap, and close to 5.5% is into small cap. So that's the market cap wise split in your portfolio. So once these two tabs are clear, then we can see what would be our appropriate benchmark to benchmark this particular portfolio against. Okay, so for that, we will have to go to the performance tab, which is the second tab here. Now, there is an auto benchmarking that happens every time you load in a portfolio. So in this case, the moment we have loaded in a portfolio, automatically reference index 1 has been chosen as a benchmark. Now, what is the reference index 1 that you will see right here? In NGEN, at NGEN, we have created a combination of equity and debt indices in increments of 10. So reference index 1 is 100% Nifty TRI, and reference index 11 is 100% CCIL bond index. And after that, there's in increments of 10 and of course decrements of 10. That's how we have built these specifically benchmarks to actually auto benchmark the portfolio performance against. Now, how will it choose auto benchmark? It will see the first level drill down, which is only this drill down, right? Equity asset class split as well as debt asset class split. So in this case, debt is very, very low in the portfolio. It will try to match the debt to the closest as possible. So in this case, a very, very low debt, and therefore it's highly, basically it's a predominantly equity oriented portfolio. And therefore it has chosen reference index 1, which is 100% Nifty TRI as a benchmark to really compare the performance of this portfolio against. But as we just saw, the current concentration or the current exposure in the portfolio was between large, mid, and small. Therefore, what you can practically do is you can go here in custom benchmarks and build a benchmark which is respective or relevant to your portfolio, right? Depending upon its exposure. Of course, this is current exposure. This is bound to change when we go ahead in time, and then you'll have to keep on updating those benchmarks. Alternatively, what you can also do is choose from one of the other benchmarks. So for an example, if you want to simply benchmark this portfolio against a Nifty 500, so that is something that you can typically do. You simply go from here, NGEN to NSE tab. Here you will get all the available indices to choose from NSE, and then you can typically choose Nifty 500. So this option is also there. Alternatively, you can go here in custom benchmarks and actually click on add a custom index. Give a allocation as per the current market cap exposure of the portfolio, and then choose that as the benchmark to benchmark the portfolio against. That's possible. Okay, let's now consider for example sake or use case scenario Nifty 500. So I'm going to benchmark the portfolio performance against Nifty 500 as my benchmark. And now for running this analysis, I'm going to choose a 5-year period. So I simply go here and change the start date to a 5-year period. The start date option to change the date is available right here at the center. Once I do that, I ensure that the benchmark that I've chosen is back in place. So Nifty 500. And now I can see my portfolio's performance against that of the benchmark. So here you will see the benchmark has given about 112% return. My portfolio has almost given similar levels of return. So what do we mean by cumulative return? It's nothing but an absolute return from a point in time to a point in time, right? So starting from the start date that we have considered, that's 21st January onwards to 24th of January 2024. So this is a 5-year return, absolute return by my portfolio as well as by my benchmark. So in this case, I can see it's a matching up that they are playing, right? It's very, very similar. The returns are very, very similar, right? But what is the risk that this particular portfolio has taken to achieve that return? So that can be checked here in annual volatility, which is an indicator of the standard deviation of the portfolio as well as of the benchmark simultaneously, right? So in this case, I can see the benchmark has taken in a risk of about 18%. To gain a return of about 112%. On the other hand, my portfolio managed to generate similar levels of return with a much lesser risk. So practically 3% lesser risk, right? Therefore, because the return per unit of risk was higher for my portfolio, it is but obvious that my Sharpe ratio, the portfolio Sharpe ratio, will be better than that of the benchmark. And that is exactly what you can see in this Sharpe ratio numbers. So Sharpe ratio is typically risk-adjusted returns. So you see the portfolio Sharpe ratio is 0.57, close to 0.60, and my benchmark Sharpe ratio is about 0.50, right? So you can see clear difference because the volatility of the two portfolio, rather the portfolio and the benchmark is different, though the return is same. Next, what we can also check is with respect to the value at risk as a parameter. This is a measure of the downside risk that is there in the portfolio. So if we were to interpret this in layman terms, we can say that if 100 rupees is invested simultaneously in the benchmark, that's Nifty 500, as well as my portfolio would go down by a negative 23.29%, right? On the other hand, my benchmark in the same time period will go down by a 25 rupees, right? So in case of my portfolio, my capital will be protected to an extent of about 72 rupees, or rather 77 rupees. On the other hand, in my benchmark, my capital would be protected only to an extent of 75 rupees, right? So you're better off with the portfolio when we consider downside risk only as a parameter. So typically for conservative investors, if you're building this portfolio, then your target should be as low this number is, it's a good thing, right? This is an indicator of the downside risk that is there in your portfolio. Next, let's come on to up capture and down capture ratios, which typically tell you what is the catching up that your portfolio is doing when the benchmark is in a bull run, right? For up capture ratio, we consider only those months when the benchmark was giving in positive returns. So the moment we click on this eye icon that you see beside this up capture ratio, you will see a month-on-month split every single month and the benchmark returns of that of those months, right? So in this case, you will not see a single month when the benchmark gave a negative return. For an example, let's consider this March 2023. In this month, the benchmark gave in positive return, right? On the other hand, my portfolio fell by a negative 2.34%. Right? But in spite of that, that month is captured. Why? That's because benchmark was in a positive, gave in positive returns. Right? For an example, after November 2022, you will see the month that is directly captured is March 2023, right? Because what happened in between months, December, Jan, Feb, the benchmark would have given negative returns. And therefore, those months are not captured at all in the up capture ratio. And that's why we term up capture ratio as the benchmark's performance in a bull run. Okay, so my benchmark gave in positive 64% cumulative in a bull run. On the other hand, my portfolio only caught up 56% in the same at the same time, right? So therefore, what I can interpret from this is if from this ratio of 86 that you can see here, if my benchmark goes up by 100, my portfolio is going to go up only by 86, right? So this is what up capture ratio will tell you. So it is but obvious that higher the up capture ratio would be more desirable for any particular client, right? So if it is beating the benchmark in a bull run, then that's definitely something that's desirable. Exactly converse is the logic of down capture ratio, right? When we come to down capture ratio, it tells you how much is the resilience of your portfolio when the benchmark falls or when the benchmark is in volatile period, right? So you simply click on this button, you see all of those months. Now only those months will be captured when the benchmark has given a negative return, right? Whether irrespective of the fact whether the portfolio gave in positive return or negative, right? For an example, in this case, January of 2020, look at that. The benchmark gave in negative return, but my portfolio gave in positive 0.34% return. But still that month is included. Why? Because benchmark gave in negative return. So what we are focusing on is the benchmark returns, right? Again, cumulate all of this up. We can see that a benchmark falls by 35%. Over the last 5 years, my portfolio has fallen only by a negative 29.5 odd percent, right? So it is definitely more resilient to losses when the benchmark is going down, right? So this is the relevance of up capture and down capture ratios. You can highlight this in portfolio analytics when you're sitting with clients for your reviews. Next, let's come on to the second part of our discussions in this webinar, which is understanding overlap analysis and contribution analysis, but not independently. We are going to see that in tandem, right? How we can use one, how one complements the other, right? So for that, first, let's come to overlaps. Now, overlap analysis is typically to help you understand what is the diversification metrics in the portfolio and how does it really look like, right? So if you see color coding into pink or dark red, or for that matter, even this yellow color, that means that there are funds in the portfolio that have very, very similar holdings, right? For an example, in this case, I have a Mirai Asset Large Cap Fund and also a HDFC Top 100 Fund. Of course, both from large cap universe, and they have 62% same holding, same stock holding. So their underlying holdings, 62% of them are similar. If you want to have a look as to what all are the underlying stock holdings that are similar, you simply click on the 62% cell. You will have this list open right in front of you. So you see that, okay, HDFC Bank as a stock is held by both the funds. Mirai Asset holds it to an extent of 9.94. HDFC holds it to an extent of 9.25. So therefore, the minimum of the two or the lower of the two is going to be overlap. So 9.25 is common across both. Therefore, that will amount to overlap. Now, how have we arrived at the 62 figure that you see here? That is simply a summation of all these overlap column numbers, right? So 9.25 plus 9.10 plus 6.67 and so on and so forth, right? A summation of all of that comes to a 62%. And this typically means these are the common stocks in both the funds portfolios. Okay. Now, instead of typically including two funds with overlap, which is as high as a 60%, or for that matter, even a 43%, we can actually pick and choose one fund among these two, right? Similarly, we can pick and choose one fund among these two, PGIM and Mirai, right? Now, how do we choose that fund, right? How do we take a decision, okay, should I exit from HDFC Top 100 or Mirai large cap? Because even if you remove one fund from this list, this overlap is going to go away, right? Because this overlap is between these two funds, right? Mirai and HDFC, and of course, Mirai and PGIM. Similarly, for HDFC Top 100, it's with, again, Mirai. It's a metric structure, so it's going to be similar. And of course, a IPRU equity and debt. Now, in order to check or in order to take such decisions, what we would be typically referring to is the contribution analysis tab on the portfolio analytics tab. Now, contribution analysis tab helps us in determining the contribution of every fund that is a part of the portfolio to overall portfolio return, right? Simply summarizing and going back just one step before we go ahead to contribution, we saw that the overall portfolio return is 112% return, 112% over the last 5 years. Now we want to check which fund has contributed the best to this 112% portfolio return. For that, we are going to contribution analysis, right? The moment we come to contribution analysis, you will see the components, all the components of the rather portfolio that are listed here one by one. And after that, the first column that you will see is the total returns column. Let us first understand what this total return column means. So in this 5-year period, let's say instead of having a portfolio of 8 funds, you had only Motilal Oswal Mid Cap Fund in your portfolio. So your portfolio has only one fund. Then your portfolio return would have been 206%. Why? Because Motilal Oswal Mid Cap Fund's return for the last 5 years is at 206%. Right? And you can even cross verify this. You simply click on this particular fund. It gets open in a new tab like this. And of course, you need to ensure that the start date that you're running this analysis for is similar, right? So we were running this for a 5-year period. You change the period to 5 years. That's January 19 to January 2024, and look at the return, right? So cumulative return is at 212%. That is exactly what was there here in the portfolio analytics tab. Okay, once this is done, what we then do is, what we then analyze is typically how much is the allocation. So in this case, it's an equally allocated portfolio, right? So each and every fund is going to get an equal allocation. In spite of being an equally allocated portfolio, the contribution of each of these funds to the portfolio returns is different. The highest contribution is by Motilal Oswal Mid Cap Fund to an extent of 22% out of, if we standardize the portfolio return to 100%. Now, here is where we can actually take decisions, right? In overlap analysis, what we saw was there is pretty high overlap between a HDFC and a Mirai. And we were to choose one fund among these two. Between HDFC and Mirai large cap, I want to choose one fund. Now, what will I do? I simply go to contribution analysis. I check which among these two funds is a better performing fund. So if I compare HDFC and a Mirai Asset Large Cap Fund in the last 5 years, I see HDFC has given me a 108% return over a last 5-year period. And therefore, its contribution to the overall portfolio return is also very, very good. It's 11%. Versus to that of Mirai, which is only 93% return, though the difference is only about 15%. But there's still a difference, right? And if we can eliminate one fund from this list, we can definitely avoid the overlap, which is coming in the portfolio, right? Instead of keeping two funds which ultimately have 60% same holdings, we can rather take a decision to exit from one of them, which does not really give good returns, right? Now, once this decision is made, what you can typically do is to remove this fund from the portfolio is you simply go here and click on edit or save as, right? So this button is right there at the top. You click on this and this window will open up, which will let you edit or rather add or delete funds from this portfolio composition, right? So what we had decided is we would like to liquidate Mirai Asset Large Cap Funds holdings. And mind you, here we are just doing an analysis. So when we present this report to the client, we are saying that, okay, even before executing the transaction of liquidating this fund from your list, we are showing you what your returns could be if you do not include this fund and give this allocation to a better fund, right? So Mirai Asset Large Cap goes. And for simplicity's sake, I'm just going to add that 12.50% allocation that was removed from Mirai Asset Large Cap to HDFC Top 100 Fund, right? So I'm simply going to change this allocation 12.5 plus 12.5. That's 25%. And this is what I'm going to do. And I'm going to simply click on update. Of course, what we could have also done is we could have added another fund, but that typically for the webinar sake for use case, I'm just increasing that same allocation to a better performing fund, which was HDFC in this case, right? Once this is done, you simply click on run again. Now you see it's a 7-fund portfolio, and let's change the start date again. Yeah, so this is now a comparable 5-year performance that we were seeing. Compare that with Nifty 500. That's our benchmark. That is what our benchmark was. And we see there's a 2% excess return by my portfolio versus to that of the benchmark. Because if you see priorly, it was, the portfolio return was similar to that of the benchmark, right? So 112 plays 110, 112. In this case, the portfolio return has improved by a 2%. Cumulative basis, of course, right? And this is what was the benefit of actually exiting from Mirai and including HDFC in that case, in the place of that, right? Of course, that would have definitely impacted our overlaps. Our overlaps have now reduced. Now, we see, of course, HDFC Top 100 and PGIM is again 61% overlap. And of course, there is with IPRU, equity and debt fund. You could also, repeat this process further to actually try and choose a better fund among these two. But the process is similar, so I'm not going to repeat the same process. But this is something that you can keep on doing unless and until you feel that, okay, this is a decent overlap and I can go ahead with that. Right? So this is one analysis that you can do, wherein you can consider overlap analysis with contribution analysis. Instead of considering each of these steps independently, all of these can be considered in relative terms and a decision can be arrived at. Okay. Now moving on to the third part of the webinar discussion, wherein we were to understand the drawdowns analysis. Now, when we load in a portfolio, these are portfolio level drawdowns analysis. So what we aim to do, or what is the utility really of this drawdowns analysis, is it helps you in determining what was the strength of your portfolio when it was actually, reporting losses. So by strength, I mean how quickly did it recover from a loss, right? Because how much ever process research you do, how much ever curated process you follow for including funds with higher returns, it is never going to be such that the portfolio is going to be immune to any losses, right? When there are black swan events like a COVID-19, or for that matter something like a global meltdown, then of course the portfolio is going to fall. But in such cases, what becomes very important to note is how quickly does the portfolio recover from that loss, right? And that is exactly what we aim to address in this drawdowns analysis. So this can be actually termed as drawdowns and recovery analysis, right? This is what you see. So first of all, the table that you see here lists top 10 drawdowns in the in terms of their magnitudes, right? So the worst loss that this portfolio ever experienced in this 5-year period that we are analyzing from 2019 to 2024 is a loss of 32% magnitude, right? When did this happen? This happened exactly at the time of COVID onset, right? January 2020 to March 2020. In a 2-month period, the portfolio fell from a NAV of 112 rupees to a 75 rupees, right? That is exactly a loss of 32% in magnitude. After falling so much, after falling about 30 odd percent, the portfolio next took 169 working days to recover this loss in entirety, right? So 169 days after what? After this end price. Okay, so what happened after these 169 days? And that happens to be on 13th of November 2020. This 169 days after 23rd of March 2020, which is the end date, happened to be 13th of November 2020. Now, what happened on that date? On that date, the entire loss was recovered and the NAV of the portfolio reclaimed the level of 112.89. And this is something that you can corroborate also on this line chart. So for an example, let's try and find 13th of November 2020 on this line chart. So the gray areas that you see here indicate loss periods, right? Drawdown periods. And the white portions that you see indicate the recovery periods. So we will typically be seeing this 13th November somewhere in the white portions. So let's try and locate that. So we are, yeah, 1 second. So we've reached 27th of November. Okay, right there. On 13th of November 2020, if you if you have a look at my mouse and where it is pointing at, the NAV of the portfolio got to a level of 112.90, which is 0.01 above the start price that you could see right there in the first row, right? 112.89 was the start price when it started falling, right? On 13th of November, it breached that level and crossed that 102.89 resistance, and it reached a level of 112.90. And therefore, we call that as a recovery period. Okay. Now what we've done is we've listed losses on the basis of magnitude. So this is the worst loss, the second worst, third worst, and so on and so forth. And after that, what we've done is we've listed the number of days that it took to recover from its drawdown. Right. And typically when you're sitting with clients for review, what you can highlight is not just this, your portfolio typically recovers, rather has recovered all the past 5-year losses, right? In the in a matter of 6 months, right? Just over 6 months. in terms of working days, of course. It has never taken more than 169 days to recover any loss. And this 169 also happens to be this one-off event, which was COVID meltdown, right? Other than that, it has been pretty resilient in actually recovering from the losses. And this is something that you can highlight, right? This was the drawdowns analysis and, of course, the recovery analysis. Now, once this is done, what we can also do is highlight scenarios. Scenario analysis becomes crucial when there are some typical events, right, that are happening in the markets, or you would like to showcase the performance of your client's portfolio in those events versus that of the benchmark. So for an example, typically we have a budget session that is upcoming in the next week or so, right? So let's consider what impact did last year's budget have on this particular portfolio. So for that, what you can typically do is go to scenario analysis. You go here, add custom scenario. You put in the name of the scenario. So of course, this will be a historical analysis. So we will put budget 2023. We put in a start date of maybe 1 month prior to the budget, and maybe we can take 1 month post the budget, right? So let's say 2nd of January 2023 is the start date, and end date could be a March or a Feb end. Let's consider 1st March 2023, right? So we have covered this 3-month period, January, Feb, and March. Sorry, 2-month period. You simply save this as a custom scenario. And once this is done, you need to simply locate that scenario. So this got saved here, budget 2023, and you see the performance of your benchmark versus the performance of your portfolio highlighted in the graphical manner as well as the tabulated manner. The black line shows the performance of your benchmark, which is Nifty 500 in this case, and the blue line is the indicator of your portfolio performance, right? So benchmark fell by a -5%. Right. On the other hand, your portfolio also fell, but it was resilient that way, and it fell only by a 2.5%. Right. And therefore, you see excess. This is actually, it fell lesser, and therefore is termed as excess return. Right. So benchmark going down by 5%, your portfolio going down by -2. That's a good thing. On the other hand, we've recently, in the last 3 months, we've had a up move or a rally in the markets, typically after Diwali, or for that matter, after elections of some states were declared. You want to check that scenario and you want to highlight that for your client. Then what you can simply do is, I've actually previously saved the scenario. I simply click on this. I've chosen in a time period of November to 15th of Jan, and I can check that the benchmark in this time period actually went up by a 18%. Mind you, this is the up move in this period, a short period of 2.5 months. This 18% was the up move by the benchmark. On the other hand, your portfolio went up by a 17%, 17.5% to be precise. So the catch up was not very good. Basically, it was little less, 1.55% less. Alternatively, if you want to check year 2023 gone by your performance, you can definitely check that as well. You can create as many scenarios, custom scenarios as you would like, and simply check the performance of your portfolio against that of the benchmark. So in last year, 2023, your portfolio's performance was 2% excess than the benchmark's performance. This was all the analysis which you can do when you're sitting with your client for review, right? I've covered major analysis tabs. And once this is done, you would like to make a presentation for your client, right? And therefore, we'll come to the reporting options that we have on the platform. So we have a 4-pager standard PDF that you can definitely use to present the performance of the portfolio. And you can simply click on this. You will have your own organization's watermark at the background, and you can simply check this box before generating a PDF. And that is how a PDF will look like. I'll simply open this. This is a standard 5-pager PDF. The last page, of course, will be a customized disclaimer, and you can change the disclaimer. But this is how the first page will look like. You'll have your own company name and logo here appearing on the left-hand side, comparing performance of the portfolio versus that of the benchmark. The same analysis that we were doing on the platform gets exported into a PDF. Because the PDF, it is that way pretty standard, and therefore we also have in order to make some customizations, we have given a PPT option. You simply click on this, and a editable PPT gets generated. So let's generate a percentage-based PPT. You click on create PPT. A PPT is going to get downloaded, and it is going to be customizable. So let's say you want to highlight the scenarios that we were just discussing, right? When you are actually sharing this PPT with your client. Then what you can do is you can simply open this PPT, and you see the scenarios tab is not specifically exported when you're generating this. Why? Because different clients would like to have, or rather like to highlight different scenarios for their clients. And therefore, we've not by default included the scenarios tab. But instead, we've given you an editing option, right? You simply add a new slide. It gets added right here. Once it is added, you simply go back to the platform. Let's say you want to highlight last budget scenario, right? So you go here, you take a section specific screenshot by clicking on the screenshot option. Once you click on that, a section specific screenshot for this particular analysis will get downloaded. For use case, I'm just taking a snip, but snapshot is something that you can do, right? Include this snip in the PPT and make it customizable for your client, right? So you're highlighting the scenario to the client. You can add your comments here. I mean, it's a PPT ultimately, right? You can add whatever customizations you can or you want to do in the presentation. Once all of this is done, you can then save it as a PDF and then take it with the client. You can add as many scenarios because there is no typical limit in including new slides. Or rather, even if you want to, let's say if this rolling analysis is going to get extremely technical, if you think for the client, what you can typically do is delete this slide, right? So that option stays with you. So this is how you can generate actual customizable reports for your clients and actually sit with them for review. That was all from my side for the webinar related discussion today. If you have any questions, now please go ahead and either type in the chat box or directly unmute yourself to speak. Thank you.
Hi, Girish here. Hi, Prajakta.
Yes, hi, please tell me.
Yeah, so can we go back to the concentration side?
Sure.
Yeah, see here, we can see that 72% is in large cap, 16 in mid and all these things, right?
Yes.
I would appreciate if you can give us an opportunity wherein if I click this 72% area, all the stocks under this should reflect over here. So that we can understand, okay, which large cap stocks are here. So there is no way that we can differentiate what is a large cap, mid cap, and small cap in from this entire this thing. Unless I download that.
Yeah, unless you download. Yeah, so basically that split is available when you download it into an Excel, and then we have specifically given columns with what is
that's
large cap, what is
adds up to the work, right? So
yeah. Okay.
we can do that. That will give us a snapshot of what exactly are mid caps and small caps under this portfolio. If it is
Yeah, that's fair enough. Prajakta, let's write this down. We can add something here where maybe clicking on the pie chart shows the list of stocks that make up that chunk. And in the meantime, while we release this, as Prajakta was showing, you can obviously download it, and in the download, it will say large cap, small cap, mid cap.
yeah, that I'm doing now. So
Yeah.
that would only thing is that adds up to the work. So
Of course. Here you have to sort it, and
sort it and all those things we need to do.
Fair enough.
Again, we don't know what is exactly the total percentage. Again, adding and all those things, it is involved when it is Excel. If it can given here, it is just a snapshot. With a glimpse, understand what are the things that are there in this large caps and mid caps.
No problem with me.
Sure. Yeah. Thank you.
So we have a few questions in the chat box. Yeah. So the one stocks related was answered. Will large, mid, small allocation show properly, inclusive of FOF and international funds?
Sure. So currently, we don't currently don't provide a second level drill down into the holdings. If a fund is holding another fund, we only show them as another category called mutual funds. So currently we don't provide a second level drill down into the holdings of funds which may be mutual funds. So currently they do not.
Okay, there's another question in the chat box which says, do you have total capture ratio, which is a combination of up capture and down capture?
So we don't show that as of now. We can look into this. I wasn't really aware of capture ratios being shown like this, but we'll definitely check. We'll check up. If something that has a general formula that's used widely, then we'll put it in as well.
Hi, Prajakta. I had a question.
Yes.
When we are updating the portfolio or when we are putting in the portfolio, we don't take the start date of the start date of the investment of the fund, right?
That's
So
correct.
on what basis are we taking the start date, or how do you exactly do it? Because it won't give the right analysis if I've started the investments one fund 2 months back and other fund a year back.
Right. So what we do on this platform is a hypothetical historical backtest, right? So when I'm saying that I'm choosing a start date of 21st of Jan 2019, I am assuming here that these funds were there since that. I mean, basically, I held on to these funds from that time period. There was no change, right? Because that is what I am typically using for analyzing or making decisions as to these are the funds that are currently hold. Okay, irrespective of the fact when did I start investing in them, because this is not a calculation which gives you a portfolio XIRR, or a return or profit and loss of a portfolio. This is like analyzing your current holdings and what are their current contributions to your portfolio if they were held like this for the last 5 years or for the last 2 years or for the last 1 month for that matter, right? So that really depends on what start date you choose, and which is of course customizable. So the transaction reporting or the calculation of profit and loss, though important, that is not something that we do on the platform.
Okay, so if I have like a 15 mutual fund portfolio and
Yes.
every fund has a different start date of investment,
Yes.
what do you suggest me to do? Like choose the one which has been started much before, or how do I go about it?
Sure. Just I'll also just chime in here is that if you have a portfolio of 15 mutual funds, the analysis that we're showing here is not what you have done for the client until now. It is more looking at whether this portfolio is good for the future or not. So in that sense, it's not really relevant how you got to these 15 positions. What is relevant is that you hold these 15 positions today, and tomorrow and day after and next month's P&L will be driven by only what you're holding today. So this is an analysis of basically what your portfolio could provide in terms of return, because what we're showing you on the performance tab here is the historical price of this portfolio. In the same way that you would check the historical price of a stock before buying it, whether or not you have bought it in the past, you will always just look at the actual pure price of the stock, regardless of your own trades. So what we're doing here is the analysis that you could show to your client is that this is your current portfolio. This is the historical price of this current portfolio. It doesn't show you what your actual P&L is. That is a separate matter. You will get that from your back office software. But what we are doing here is giving you an idea of how good or bad this current portfolio is.
Okay, got it. So this would not affect my contribution, the tab what Prajakta showed. The returns over there would not be affected irrespective of the date what I put.
Exactly. This contribution tab will show you that in this historical backtest, this is how the returns were made.
Okay, got it. So that just for clearing the doubt, so total return indicates if I'm holding only that fund in the portfolio, how
Yes.
much would I return be?
Yes.
And the second one, what does it indicate?
Sure. So 108.34 here basically tells you the return of that actual fund, and
Okay.
23.33 is basically out of 100. So if your total return was 100, so 23.3% of the total return has come from HDFC. So this is giving you that almost a quarter of the return is coming from one fund.
Okay, got it. Yeah, thank you.
Sure.
So there's a question in the chat box which says, do we capture turnover ratio anywhere for the respective fund? We, as of now, do not capture portfolio turnover ratios anywhere on the platform.
I think we should, right, Prajakta, because that will add up to the risk of the fund. So when we say the fund is risky,
Yeah.
highly, so the higher the turnover ratio, that means that the churning of the portfolio is too much. So in that case, it indicates the risk that is involved under this. So it's like, that is my understanding.
Fair enough. We will inquire with our data provider to see if this data is available for us to use, because obviously this comes through the AMC for each individual fund and will come through the data provider. So we will check up on that.
Got it. Okay. Project, the last one from my side. Are we working on that, the error that is there? I mean, for the Mac, the NGEN benchmark is not working.
Oh, yes, we are aware of that issue. So at this point, we're trying to, well, just to clear the issue is that when you go to any of these drop downs, searching for any benchmark, on Windows computers, you can just click on this benchmark, like Prajakta can just change the benchmark, for example, right now.
Yes.
In Apple computers, that event seems to not load. So we are trying to figure out, some kind of additional solution to that. It's under process, so we'll hopefully, get
Kindly
this.
do that, because I use Mac, so I don't have any other system other than this. I have a couple of
Understand.
Macs itself, so it's
Understand.
yeah,
Understand. We will try to figure something out for this.
yeah, please.
Sure. There's a question in the chat box asking how we rebase the benchmark for a portfolio of 25 schemes. So yeah, so if you look at the performance page, what happens is regardless of the number of schemes, let's say it's 25, or in this case it's 7 schemes, basically both prices start at 100, the benchmark as well as the portfolio. And after that, the very next day, we calculate the actual return of the underlying benchmark. We applied that to 100. So 100 goes to 100.01, 100.02, etc. In the same way, the portfolio NAV, which is starting also at 100, will grow again at whatever percentage all the funds together, including taking into account the weightages of the fund for that day have returned, and that is applied to 100, and then on and on from there. So both lines will start at 100, and they will grow based on the return that either the benchmark is giving or the portfolio is giving.
My question to that was, like, suppose the portfolio is of 25 schemes and there are 7-8 categories. How you assign that weight to a particular benchmark accordingly? That was
Sure.
the
So
set of questions.
we don't make the benchmarks the benchmarks we create are not driven by the category allocation of the portfolio. So even the benchmark that we've created here, they are basically very general benchmarks where 90% equity, 10% debt, or 80% equity, 20% debt. But that's the only variation in the benchmark here. So you can basically get a decent idea of your overall asset allocation. But we don't then customize the benchmark further based on what the portfolio is doing, because that kind of defeats the point if the benchmark is following the portfolio. So we don't rebase our benchmarks in that way.
But essentially, then it would not be a right comparison for the overall, actually, if you are trying to derive some connotation of the portfolio performance vis-a-vis kind of a benchmark we are trying to put, then that will not reflect the right kind of a performance comparison.
Well, that depends what you're trying to show, right? Because, for example, if I have a portfolio which is 50% large cap, 25% small cap, and 25% mid cap, and then I make a benchmark which is 50% large cap index, 25% mid cap index, 25% small cap index. The performance of this portfolio versus that specific benchmark, firstly will be, it'll just show you the value in picking the stocks and no value in picking large mid cap. because the benchmark is exactly proportioned in the same way that the portfolio is. Secondly, the problem is historically that 50, 25, 25 may not be the same while we are considering a benchmark which is 50, 25, 25. So the issue here is that ideally a benchmark is supposed to be something for a portfolio to beat. But if we are going to change the benchmark every time we change the portfolio, then it becomes a funny situation where we are creating our own benchmarks as we change our own portfolio. So ideally, a benchmark should be a standard item which people can invest in, so they can see what's the point of coming to us and investing instead of just buying Nifty, which everybody can do. So our benchmarks are not constantly changing to follow around the portfolio asset allocation, because it kind of defeats the point of benchmarking then.
I take your point, but suppose you want to evaluate, suppose of 25 funds in a portfolio over a period of 3-5 years, and some funds are underperforming. In your kind of a platform, I don't see we have a tab or something where we at least we can show a portfolio-level performance vis-a-vis the benchmark performance on the same kind of a platform. So at least we can figure it out relatively which of the funds are underperforming vis-a-vis the benchmark, and we can highlight to the clients to take a much more meaningful kind of decisions for the portfolio. So if that kind of a tab or something, if you are able to provide additionally, that will help kind of investors taking the right investment decisions, which will help many of the distributors.
Are you talking about the individual benchmarks for each individual fund?
Yes.
Right. So see, so there are two things here. One is you can create your customized benchmarks here anyway. So there is a place where you can create a benchmark as per your liking. You can select from any of the indices that we have and apply a weightage to them, create this benchmark and save it. And once it's saved, it's basically, it's updated on a daily basis from our end at the back end. So whenever you load it, it's up to date. So you're free to create benchmarks here. The second thing about individual fund benchmarks, we don't, if you just load any fund here, just load a large cap fund or something like that, whatever from here. You see here, we've got, the benchmark by the fund manager is the BSE 100 TRI, right? Now the issue is that, every fund manager has gone and kind of decided what their benchmark should be, which is not really ideal, right? You're asking the player to referee themselves. So we don't really pay that much attention to the benchmark that the fund manager has said it should be. It's up to the user to define that, okay, this is a large cap fund, so maybe I'm just going to put it against Nifty 50 or Nifty 100. So you can choose from the top right here. This is by default loaded something, but that's not important. What's important is you can choose what you want to benchmark their fund against. So we don't really pay too much attention to the fund manager declared benchmark at all.
I take your point, but what I'm trying to say is in the stats column, suppose we are putting this as a presentation format to the client, but suppose on an individual, kind of a things also, if you see the stats, suppose we are presenting this stat, but vis-a-vis this, if you can also on a subline, if you can put it the benchmark performance in that way, so at least in a one presentation, we can highlight that to a client how has been the historical performance for the fund and the benchmark, which makes the overall presentation much more meaningful.
So here we can, in this table, we can easily add another additional line on the top, which will give you the return stats for the benchmark that you are currently using for this portfolio. That is possible.
No, that will not also be, even if it is not also, if you see, for an example, Tata FlexiCap performance, we have the historical performance for this. And on below a subline, if you can share us what is the kind of a benchmark performance, and if you can wish as a optional option, some distributor want to kind of use it or not, that will be kind of a much more meaningful kind of a data incorporation in one kind of a presentation. So
sure. I mean, so for the case of Tata FlexiCap fund, what benchmark would you want to use?
So So we know that the benchmark may be of 500. We can click there and we can check. But what I'm trying to say, if the option is there, at least in one platform, we can kind of put it, what has been the performance of the benchmark, and basis that relative performance or underperformance, if the investors wish to take any call, they can take. Otherwise, what will happen? I have to separately, kind of make a 25 sliders and separately put out and vis-a-vis the performance, and we have to incorporate slightly some different slides that way.
Right. So we can look into this. I mean, the only one thing I can think of is that we can put the category average here for the flexi cap category. Because because that will give you a sense of what this fund is doing versus other
at
funds.
least a category average or something. So at least we can at least relatively one can look at the stat historical, and investor and the advisor can look at whether it is tracking or it needs the attention of the investor or the advisor that way.
Yeah, we can try to put the category averages here, because the problem is, Tata Flexi Cap will have some other benchmark, some other Flexi Cap will have another benchmark. So those comparisons, when put on the same page, they're just at least in our opinion, it's wrong, right? Because you're saying one Flexi Cap has one benchmark and then the other Flexi Cap has some other benchmark. So it's kind of almost not fair to show clients information like that, because it's not right. But what we can do is put the category average statistics here below each fund. So for example, large cap has 3 funds here. So maybe an additional line goes here at the top or the bottom of this 3 funds, saying this is the category average for large cap funds, and this is how the funds have done.
We can do that. Otherwise, also suppose if it is much more inconvenience, at least in the compare section, we should go and we should have an optional option, the benchmark performance, and we can, once we are able to kind of get the data, Excel data, we can kind of transport that, and vis-a-vis that there we can pull out the data. But here also we don't have that option to kind of pull up that data.
So here you can add any index you want to the comparison section.
So
you can add indices here.
That is there, but if additional, kind of if you can put it, that would be handy. What I'm trying to say.
So what would you like to be added here?
We would like to have a benchmark, each funds to have a benchmark, kind of a performance option.
Versus their specific benchmark.
Right.
See that, I mean, I don't know, we can take other people's opinions, but that's just wrong, right? I've seen other platforms do it. I think Morningstar also does it, but it's completely wrong, because if you're basically going to say that the alpha of Axis Focus 25 fund is 2% and the alpha of Tata Flexi Cap is 3%, those two numbers are just not comparable because they're against 2 different benchmarks. So it's like I'm saying I'm taller than my brother, and Saud is saying he's taller than his brother. The information is useless, right? Because we don't know how tall our brothers are. So that, in fact, that's the entire reason that we put one benchmark on the top, where you can compare every fund to one thing only. Because if you have a beta, so on the right hand side, you can see relative columns here. There's an annual excess return, which is the performance against benchmark. Now, these numbers you can compare, because let's say, okay, we've chosen Nifty 500. So you can see the annual excess return of each fund versus Nifty 500. Now, imagine if these numbers were against all different benchmarks, right? How would that make any sense? Because it depends on firstly, you don't know what the benchmark is. And secondly, one benchmark can be completely different than the other benchmark.
Yeah.
So,
in that sense,
See, add to this discussion. Yes, please carry on.
Yeah, but the risk return profile of each of the funds are different. Like, so it will not be in a kind of as you were trying to give a semblance by putting a probably Nifty 500 as a rebasing as a benchmark, but the risk return profile for each weighted funds will be different vis-a-vis a Nifty 500 risk return. So it would ideally not be right to kind of compare with a rebasing everything to a kind of a 500. Though at least
Right.
it will be giving a guidance per se, but it would not be a kind of a peer-to-peer kind of a thing. That is my senses.
Understand. I mean, we look into this. The other issue is also that a lot of these funds have declared benchmarks for which some of their data isn't easily available. So we'll have to go through and see how much benchmark data is actually freely available for us to put on the platform. So that is also something that has to be sorted.
I
We
think
can obviously
every benchmark of an amphi, kind of a thing I think mostly are available on your try thing. Mostly everything is total return index, and I think we can work on that at least. That can give us a fair thing, and then probably depending on the advisor and their client's requirement, we can customize the benchmark as you showcased earlier. That we can use it, but at least
Correct.
additionally, each funds having a benchmark kind of a performance. Additionally, you should have a kind of a tab where we can pull up that kind of a set of data. That would be handy. What I'm trying to say.
Understand. So, I mean, we'll have a look at this, to see if we can, come up with something that's a bit more meaningful. Because, for example, if for every category has a benchmark, let's say SEBI has declared, that would make more sense, because then we can just use that one benchmark that SEBI has said for all funds in that particular category. That might make sense, because then at least within one category, you don't have various different benchmarks for various different funds. Now, but even when you look at, some funds, for example, I just looked at two overnight funds. One has a CRISIL overnight index, the other one has a CRISIL liquid overnight index, which are two different indices. So then, which one do you use? And alpha against one is, how do you compare that alpha for one liquid fund with the alpha against the other liquid fund, another benchmark? So they just become, the comparison becomes meaningless. So what we can try and do is see if every category has a set SEBI declared benchmark, and then use that for all the funds in that SEBI category.
I think that would be handy, or whichever form, at least if you can at least able to pull up the benchmark performance, you should have an option or a tab, or we should have an extract where we can, if necessary for an advisor, the advisor should be able to extract the data in a handy format. That is what I'm requesting.
Understand. Okay, we'll try to work something out here.
Thank you.
There is another question asking about quartile performance. So we don't usually show quartiles, basically because and firstly, just when you say quartile, if I could ask Mr. Aruj Agarwal, do you mean like top quartile, bottom quartile of a category? Is that what you mean? Yes, so the reason we don't usually use quartiles is because depending on the number of funds in a category, a quartile can mean something or not, right? Because top quartile means how many funds. What if there's 10 funds in the category? It's not going to be 2.5 funds. So what we do instead of that is something that's much more continuous than discrete. Is use a fund score ranking. In that case, you actually get a number that's much more accurate. So you could have 100 funds, you could have 7 funds, you could have 13 funds, but you actually get the real position of that fund within the category. And you can actually see over time how their position in that category has changed, both in terms of risk or return, or just in terms of an overall performance score. As I said, because if you have 10 funds, top quartile is either 2 funds or 3 funds. In both cases, if you compare it to another category where it has 12 funds and can be easily divided by 4, that may mean 2 very different things. In our case here, what we do is a continuous methodology, which is scored from 0 to 10. So if you get a score of 9.0, that's a good score regardless of which category you're in, because inside that category you're doing really well. So that's what we use. If you have a look at the fund scores, they're available all over the platform. That might make sense. Is there anything you'd like to sorry, your query about asset allocation for international funds and ETFs. So we on this platform, we don't have any international data. So if there are foreign stock holdings, they are shown as foreign stocks in a bucket. So let's just load one up. Let's see if I think this doesn't. So yeah, just stop here for a second. So here, this is an FOF. So you can see the individual mutual funds that this fund is holding. So we don't provide a second level breakdown as of yet. This is something that some people have asked for. So we're going to look into this to try and break this asset allocation down further, so that you can see the underlying stocks when a fund is holding a fund. And for international funds, let's just load something that may have some international exposure. And they show up as foreign equity. So you can see the foreign stocks here. No, so foreign equities will not be reflected in large, mid, small, because foreign equities are anyway never classified as large, mid, small cap, because those are Indian definitions based on what we get from AMFI. So foreign equity will always show as something else.
Hi.
Right.
Regarding some nudges in the platform.
Sorry, your voice is
in the chat
breaking.
box. My query was regarding, whether is it possible to give any nudges for the funds in the portfolio, like suppose if there is any major changes like fund manager change, strategy update, or suppose for a debt fund, if there is any segregated portfolio announced, so something like that, would be helpful.
Sure. So we have a tab in the fund section for NFOs where the new funds show. But if you're looking for some kind of alert system where you get alerted when there are certain changes in funds that are in your portfolio, or let's say fund manager changes, for example, that's something that we are planning to introduce in the medium term. So we have signed up with WhatsApp very recently. And once that process is complete, we will start creating alerts, which will initially be based on returns and changes in asset allocation. So you can set up some portfolios for monitoring where we will check on a daily basis, and based on the alerts you've set up, you'll get a WhatsApp alert saying this portfolio is down 2%, or the small cap exposure in this portfolio has gone up, etc., or the fund manager has changed. So that's something that's about a medium term timeline for us. So I would say about 3 months or so.
Okay. This can be even include any major credit downgrades in a debt portfolio, this kind of things, which sometime we miss.
Yes, so what we can monitor here is as the monthly disclosures from the AMCs come in, just go to this final debt. Oh, this is an equity fund, doesn't matter. But here you can see this rating allocation. So we have AAA, AA, etc. And if that if this rating exposure changes, you'll have to set the alert that if it goes above something, then it will trigger and send you a message.
No, I think my question misunderstood. What I meant was, for suppose a debt fund, there is suppose a particular security underlying some holding particular paper.
Right.
Say suppose it was AAA rated, and
Yeah.
Initially when we look at it, it might be showing in the underlying section like you shown for a equity fund. But say
Yes.
due to some event, suppose the rating it was downgraded to AA, and there was some hit on the fund. So those kind of things. Suppose if we open, we might have created a portfolio initially. We might have discussed with the client. He might have invested. Say after 6 months down the line, when we opened the engine and something like this happened. If in the first page, if we get a notification or alert section, suppose there will be maybe 50 portfolios will be there, 100 portfolios will be there. So when you open engine in a day, if we get alerts or some kind of notification like this, then it would be a helpful tool for us to connect with the customer and inform them and discuss with them, or whether if we can do a portfolio review at that point of time.
Understand. So you want to be alerted if, for example, this you see these holdings are on the screen right now. So you're saying that if any of these ratings, which is the third column in this table, change, then you want to be notified.
Yeah, something like that will be useful, and especially this even if any segregated portfolios initiated in a particular debt fund.
Understand. Okay. Yep, that's fine. I mean, we are definitely working on some kind of alert system. So if that goes through WhatsApp or maybe just shows up on the screen when you log in, we'll see how that is going to be implemented.
Yeah, thank you.
Any other questions? Please let us know. Okay, if there's nothing else, Prajakta, we can close for today.
Yes. So thank you everyone for joining in. You can definitely have a look at our past webinar recordings on our YouTube channel. The link for that will be available right here in the platform. You simply click on that. You'll be prompted to go to our YouTube channel. There's a dedicated playlist that is created for the webinar recordings. Already 90 plus webinar recordings have already been uploaded. We've also uploaded some short videos for 1 odd minutes. You can definitely check out those as well. So thank you again for joining in, and wish you all a very happy Republic Day in advance, and have a great weekend ahead. Thank you.